November 2024, State Farm announces they're exiting California homeowner insurance, not scaling back. Exiting. Within 48 hours, Allstate follows, then Farmers, then AIG. The headlines focused on wildfire risk and climate change. But that's not what caused the exodus. Major insurers don't flee markets because fires exist. They flee when the math breaks, when premium income can never cover expected losses at any politically acceptable price point. Here's what the headlines missed. When private insurers exit, coverage doesn't disappear. It shifts to California's FAIR plan, the state-run insurer of last resort. And that plan now holds $645 billion in residential exposure, more than the entire GDP of Switzerland sitting on a backstop designed for temporary emergency coverage. This isn't about whether California burns. This is about recognizing when an insurance backstop becomes the market, and what happens when insurable. Assets quietly transform into unfinanceable. Assets that banks can't lend against and middle-class families can't sell. By the end, you'll understand why traditional homeowner insurance isn't collapsing dramatically. It's shifting structurally. How the three-stage insurance backstop spiral has repeated in Florida, Lloyd's of London, and 2008 credit markets. What FAIR plan? Exposure growth, reinsurance cost spikes, and cat bond issuance reveal about Stage 2 to Stage 3 transition. Why mortgage lenders require coverage, and what happens when that coverage exists only through government backstops. How uninsurable becomes unfinanceable through credit market mechanics, not dramatic price crashes. The 5 quiet indicators showing California is deep into Stage 2, approaching Stage 3. What historically happens when backstops designed for 5% of the market suddenly carry 40% of the exposure. Let me show you the pattern that repeats every time insurance markets transition from private pricing to government backstop dependency. Stage 1, underpricing and risk creep. Insurance premiums lag actual risk for years or decades. Insurers price policies based on historical loss data, while underlying risk accumulates. Development expands into high-risk zones because insurance remains affordable and available. The system appears stable because claims remain manageable relative to premium income. This is the everything works phase where market participants ignore mounting structural imbalance. Stage 2, market exit and repricing. Loss events accelerate or simply revert to statistical norms that premiums never properly reflected. Private insurers attempt rate increases but face regulatory caps or political resistance. Unable to charge actuarially sound premiums, insurers begin exiting the market entirely. Coverage shrinks through non-renewals, higher deductibles, and broader exclusions. Remaining insurers tighten underwriting standards, refusing to cover properties they previously insured. This is where California sits today. Mass insurer exodus with coverage shifting to government backstop. Stage 3. Backstop becomes the market. The government-run insurer of last resort experiences explosive growth, now covering 30, 40, 50% of the market. Backstop premiums rise but remain below private market levels due to political constraints. Reinsurance becomes prohibitively expensive or unavailable, forcing backstop to retain more risk. Capital markets step in through catastrophe bonds and insurance-linked securities, essentially betting against disaster. The feedback loop tightens, more exposure on backstop, higher potential losses, greater reinsurance costs, less private capital willing to participate. The system hasn't collapsed yet, but it operates outside normal market mechanics. Where's California today? Deep Stage 2 entering Stage 3. The signals aren't hidden, they're just not being connected into the pattern they represent. In 1992, Hurricane Andrew devastated South Florida, causing $27 billion in insured losses. Within 2 years, major insurers fled the Florida homeowner market. Coverage didn't disappear. It shifted to Citizens Property Insurance Corporation, Florida's state-run backstop created after Andrew. Citizens was designed to be temporary, covering high-risk properties private insurers wouldn't touch. The original mandate specified it should hold no more than 5 to 10% of the Florida market, and policies should remain in Citizens for 6 to 12 months maximum while homeowners found private coverage. By 2002, Citizens held about 400,000 policies. By 2012, over 1.5 million policies representing $600 billion in exposure. The backstop had become the market, holding 45% of Florida's coastal property insurance. Here's the mechanism that drove this growth. Private insurers attempted to raise rates to reflect actual hurricane risk. Florida's insurance commissioner repeatedly denied or limited rate increases, citing consumer protection and affordability concerns. Unable to charge actuarially sound premiums, private insurers had 2 choices: accept losses when hurricanes hit or exit the market entirely. They chose exit. As private insurers departed, homeowners flooded into Citizens. But Citizens faced the same mathematical problem private insurers couldn't solve: premium income insufficient to cover expected hurricane losses. The difference was Citizens couldn't exit. It was state-backed and politically constrained. Hurricane season losses in 2004-2005 stressed the system severely. Hurricane Wilma alone generated $12 billion in insured losses. Citizens couldn't afford commercial reinsurance at rates that kept premiums politically tolerable. Traditional reinsurance markets quoted spreads that would require 40-60% premium increases. The Florida legislature authorized catastrophe bonds, securities that pay investors high returns unless a specified disaster occurs, in which case investors lose principal to cover claims. Between 2007 and 2012, Citizens issued over $4 billion in cat bonds. This created a bizarre market dynamic. Pension funds and hedge funds were now betting against Florida hurricanes. If storms hit, Florida homeowners got coverage. If storms didn't hit, Wall Street collected premium. The insurance market had transformed into a capital markets derivative rather than traditional risk pooling. The mechanism didn't fail catastrophically. It just stopped functioning as insurance and started functioning as government-subsidized risk transfer to capital markets. Florida homeowners still have coverage, technically. But that coverage depends on catastrophe bond markets remaining liquid and willing to absorb Florida hurricane risk at spreads Florida can afford politically. If cat bond markets seize up during a financial crisis, or if investors demand higher spreads after major hurricane losses, the entire structure becomes unstable. Citizens would face a choice: dramatically raise premiums, reduce coverage, or require state taxpayer bailouts to cover shortfalls. California is following this exact playbook, just 30 years later, with wildfire replacing hurricane as the trigger event. Between 1961 and 1968, Lloyd's of London appeared financially invincible. Conservative pricing, substantial reserves, commanding premium rates, reflecting actual exposure. Then long-tail liabilities emerged: asbestos exposure, pollution damage, medical malpractice, with claims appearing decades after policy issuance. Premiums collected in the 1960s, 70s couldn't cover claims materializing in the 1980s, 90s. Lloyd's didn't collapse overnight. Instead, it experienced repricing crisis. Syndicates that priced policies assuming 20, 30-year claim horizons discovered claims still emerging 40 to 50 years later. The math didn't work. Premiums doubled, tripled, then became unavailable at any price for certain exposures. By 1992, Lloyd's faced losses exceeding $12 billion. The market survived only through massive capital injections and structural reorganization. Names: the individual investors backing Lloyd's policies were wiped out. The lesson: insurance markets reprice violently when long-tail risk reveals itself larger than premiums anticipated. California's wildfire risk exhibits long-tail characteristics. Cumulative exposure from decades of wildland-urban interface development is massively larger than premium structures reflected. The repricing isn't happening through rate increases. Political constraints prevent that. It's happening through insurer exodus and backstop expansion. In 2008, when AIG's credit default swap portfolio faced collateral calls, the company couldn't post margin. The Federal Reserve intervened not to save an insurance company, but to prevent credit market seizure. The mechanism was invisible to most. Insurance companies provide credit enhancement and counterparty guarantees across financial markets. When those guarantees become unreliable, credit markets freeze regardless of underlying loan quality. California's insurance backstop crisis creates similar feedback potential, not because Fair Plan will default, but because the transition from private insurance to government backstop changes how credit markets price California mortgage risk. This is pattern recognition based on documented market mechanics. California Fair. Planned residential exposure has grown from approximately $200 billion in 2020 to $645 billion by late 2024. That's a 223% increase in 4 years, with growth accelerating throughout 2023-2024 as major insurer exits intensified. Commercial property exposure has grown similarly, though exact figures remain less transparent due to reporting structures. Here's the critical detail. Most analysis misses. Fair Plan was not designed to be the primary market. It was designed as temporary coverage for high-risk properties between wildfire seasons, while homeowners found private coverage. The program, its original architects, envisioned average policy duration of 6 to 12 months. Homeowners would use Fair Plan as a bridge until they could transition back to private insurers once they completed fire mitigation improvements or market conditions stabilized. Current average policy duration exceeds 3 years and rising. Homeowners aren't finding private coverage and returning to the normal market. They're staying in Fair Plan because the normal market no longer exists for their properties. Many have completed all recommended fire mitigation measures, cleared vegetation, installed fire-resistant roofing, created defensible space, and still cannot find private coverage at any price. The demographic composition matters. These aren't exclusively wealthy homeowners in luxury mountain retreats. Fair plan enrollment includes middle-class families in suburban neighborhoods that happened to develop near wildland interfaces decades ago, when insurance was readily available and affordable. Their properties weren't considered high risk when they bought them. The risk classification changed, but their ability to relocate didn't. When a backstop designed for 5% of the market carries 30-40% of exposure, it's no longer functioning as a backstop. It's functioning as the market. And markets priced by political constraints rather than actuarial math eventually face repricing through other mechanisms, typically credit market tightening and asset devaluation. The warning sign isn't the absolute exposure number, it's the rate of growth and the irreversibility of the shift. If Fair Plan were truly functioning as intended, exposure would fluctuate, rising after wildfire seasons, falling as homeowners return to private market. Instead, exposure grows relentlessly quarter after quarter with virtually no reverse flow. Between 2020 and 2024, major insurers issued over 2.7 million non-renewal notices to California policyholders. State Farm alone non-renewed approximately 72,000 policies in 2024. Allstate, Farmers, Tokyo Marine, AIG, the exodus accelerated through 2023-2024. The mechanism isn't dramatic. Insurers simply choose not to renew policies at expiration. Homeowners receive 75-day notice and assume they'll find replacement coverage. Many discover the only available coverage is Fair Plan at 2-3x their previous premium with higher deductibles and more exclusions. This creates hidden stress. Homeowners maintain continuous coverage, technically, but coverage has shifted from A-rated private insurer to state-run backstop. Credit markets notice this shift even when homeowners don't immediately feel the impact. Reinsurance markets tightened dramatically for California wildfire exposure throughout 2023-2024. Lloyd's syndicates reduced California wildfire capacity by an estimated 40-60%. Swiss Re and Munich Re raised rates by 30-50% for remaining capacity. Fair Plan historically purchased substantial reinsurance to limit maximum loss exposure. As reinsurance costs exploded and capacity shrank, Fair Plan retained more risk rather than paying market rates. This isn't mismanagement, it's rational response to reinsurance pricing, but it concentrates risk. Instead of spreading wildfire exposure across global reinsurance markets, more exposure sits directly on California taxpayers through Fair Plan's state backing. The system hasn't failed, it's just shifted who ultimately bears the risk, from private capital to public liability. California authorized Fair Plan to issue up to $250 million in catastrophe bonds for 2025-2026. These securities pay investors high yields unless specified wildfire losses exceed thresholds, in which case principal is used to pay claims. Cat bonds aren't inherently problematic. They've functioned effectively in hurricane markets for decades, providing efficient risk transfer between insurance and capital markets. The concern isn't the instrument itself, but what it signals. Traditional reinsurance markets won't provide capacity at prices California finds acceptable. Capital markets are filling the gap that conventional reinsurance left. This creates dependency. Fair Plan now relies on cat bond market liquidity and investor appetite for California wildfire risk. If cat bond spreads widen significantly, or if investor demand weakens following major wildfire seasons, Fair Plan faces difficult choices. Pay higher rates to attract capital, retain more risk on its own balance sheet, or reduce coverage availability. All three options tighten the spiral by either increasing costs to homeowners, concentrating risk on California taxpayers, or reducing access to coverage. Mortgage lenders require homeowner insurance as a lending condition. This is embedded in mortgage contracts and required by Fannie Mae and Freddie Mac for secondary market loan purchases. When coverage shifts from private insurer to Fair Plan, lenders theoretically still have compliant coverage, but credit analysts distinguish between coverage types. Fair Plan coverage carries different risk characteristics: higher deductibles, more exclusions, uncertain reinsurance backing, political rather than market pricing. Some lenders have begun adding risk premiums to mortgages with Fair Plan coverage, not refusing loans, but pricing them differently. A 0.250 50% rate premium on a $500,000 mortgage adds $250 to $500 annually to borrowing costs. If this repricing accelerates, properties with Fair Plan coverage become harder to finance. Not impossible, but more expensive. And if coverage shifts to hard to finance, property values adjust downward through tighter credit availability and higher financing costs, not dramatic crashes. California municipalities derive substantial property tax revenue from residential real estate. When property values decline or transaction volumes fall, tax revenue suffers while wildfire response costs rise, creating fiscal pressure from both sides. Several California counties have experienced credit rating downgrades partially due to wildfire-related fiscal stress. This creates feedback. Insurance crisis stresses property markets. Property stress reduces tax revenue. Fiscal stress increases municipal borrowing costs. Higher costs reduce fire prevention capacity. Increased fire risk further stresses insurance markets. The spiral tightens through multiple small incremental pressures compounding over time. When insurance markets fail, property values don't crash overnight. Instead, credit markets freeze. Properties become difficult to finance. Transaction volumes collapse. Markets become illiquid. This happened in Florida coastal markets after Hurricane Andrew. Prices didn't fall 50% immediately. Instead, buyers couldn't get mortgages because lenders couldn't secure insurance certainty. Sellers couldn't sell because buyer financing disappeared. Properties with uncertain insurance become uncertain collateral. Lenders can't value assets they can't insure reliably. When coverage certainty shifts from private market to government backstop, dependent on political decisions and capital market liquidity, credit markets treat the asset differently. For middle-class homeowners, this matters more than price fluctuations. A home worth $700,000 that CA ain't be financed is effectively worth whatever cash buyers will pay, typically 30-40% less. The loss isn't from price crash, it's from credit unavailability. When private insurance markets retreat and backstops expand, the hidden mechanism isn't fire risk. It's the transformation of insurable into unfinanceable. Properties banks won't lend against, buyers can't finance, sellers can't sell at previous valuations. Not because the property's burned, but because the insurance foundation underneath credit markets fractured. This is how housing markets experience severe stress without dramatic headline crashes. Transaction volumes collapse, credit tightens, financing costs rise, effective market values decline, while official price indices show modest declines because the only transactions are distressed or all cash. Here are 5 signals to watch in 2025-2026. Signal number 1, fair plan exposure exceeding $800 billion or 50% of California residential insurance market. This indicates backstop has fully replaced private market. Signal number 2, major lenders implementing explicit fair plan coverage pricing adjustments or restricting loan-to-value ratios. This signals credit market recognition that backstop coverage carries different risk. Signal number 3, California cat bond spreads widening beyond 8 to 10% or issuance targets not fully subscribed. This indicates capital markets losing appetite for California wildfire risk. Signal number 4, county-level property tax revenue declining in high fire risk areas despite stable statewide trends. This shows fiscal stress localizing where insurance crisis concentrates. Signal number 5, transaction volume in high fire risk zip codes falling more than 20% year over year, while median prices show smaller declines. This is the signature of credit freeze rather than price crash. Next episode, how uninsurable becomes unfinanceable, the credit market mechanics that turn insurance failure into asset immobility, and why this matters more than price movements for middle-class wealth. The pattern is documented. The sequence is clear. The only question is whether you recognize the transition from stage 2 to stage 3 before credit markets force the recognition on everyone simultaneously. This isn't about predicting the future. This is about recognizing when a system is operating outside its design parameters and understanding what historically happens when backstops become markets.